If you've been keeping tabs on the news, you might have noticed a common thread. Numerous billionaires, analysts, and economists are signaling an imminent financial crisis. Figures like Warren Buffett and Charlie Munger have been vocal about housing market speculation. Michael Burry of The Big Short fame has placed a massive $1.6 billion wager on a stock market collapse. And renowned real estate investor Barry Stern predicts a looming economic storm. With 70% of Americans bracing for a recession, there's a palpable sense of impending economic turmoil. A glance at Wikipedia's compilation of U.S. recessions shows that such downturns are not anomalies. While they might appear disastrous, recessions are an integral part of the economic cycle, marking a period where the economy peaks before naturally slowing down. Prior to the Federal Reserve's establishment, recessions occurred more frequently, roughly every 2 to 3 years. Post-Fed, the economy has seen extended periods of growth lasting 6 to 8 years, even reaching a record stretch of 10 years and 8 months. However, it seems we've reached the limits of the Fed's ability to stave off recessions as evidenced by the recent economic downturn. So, how can you brace yourself for the next recession? What strategies can you employ to not only survive but thrive financially? We're here to delve into these questions and more. Make sure you're always in the loop with our latest financial news updates by subscribing to the channel and activating post notifications. Now, let's dive back into the video. First and foremost, prioritize having cash on hand. In challenging times, cash acts as a crucial safety net. When the economy is booming, it's tempting to invest in trendy assets like cryptocurrencies or digital art. However, the onset of economic uncertainty often prompts even the wealthiest to liquidate investments in favor of holding more cash. Take a cue from Warren Buffett. He may not be ostentatious, but he's prudent, maintaining a substantial cash reserve for opportune moments. Preparing for a recession involves reining in superfluous expenses. Even minor outlays, such as your routine coffee purchase or that impulse buy of trendy sneakers, can accumulate, more so amidst rising inflation rates. Moreover, current supply chain disruptions are inflating costs, potentially requiring an extended period to normalize perhaps over a year, to fortify yourself against impending economic challenges. The key is to save diligently. You don't need to be a financial guru. Simply exercise smart financial management. Secondly, consider investing in financially resilient businesses. In times of economic hardship, numerous companies face difficulties, with some even succumbing to failure. Employees grapple with personal financial obligations, complicating operational sustainability for businesses. The 2008 financial crisis serves as a stark example, where corporate giants like General Motors, Chrysler, and AIG teetered on the brink of collapse, necessitating bailouts from larger entities or government intervention. When allocating your investment capital, opting for companies with a financial cushion is a strategic move. Companies such as Apple and Microsoft, known for maintaining substantial cash reserves, exemplify this approach. They prefer a gradual erosion of cash value due to inflation over the risk of capital inadequacy during a recession. A company's fiscal health can be gauged through its financial statements, particularly the balance sheet, which reveals the adequacy of its cash reserves to withstand challenging times. However, it's important to note that not all companies possess the financial robustness of industry titans like Apple. Thirdly, view a recession as an opportunity. Contrary to instinct, launching a business amidst a recession can be a strategic decision. In flourishing economic conditions, competing with established corporations can be difficult. However, during economic downturns, as these large entities grapple with their own challenges, the stage is set for new startups to emerge and succeed. Consider the case of WhatsApp, which debuted in 2009 during an economic downturn and was subsequently acquired by Facebook for an astonishing $19 billion. Its current valuation, bolstered by a user base exceeding 2 billion, is even higher. Uber, also founded in 2009, now boasts a valuation nearing $50 billion despite its modest profitability. Other notable examples include Pinterest, Venmo, Slack, Square, and notably Bitcoin, which was conceived in the aftermath of the 2008 financial crisis by Satoshi Nakamoto, catalyzing an industry that propelled many to millionaire and billionaire status. Cryptocurrency platforms like Coinbase, Binance, and Gemini are testaments to this. Tesla, which narrowly escaped collapse during the crisis, not only survived but emerged as a dominant force in the automotive industry, outshining competitors struggling through the downturn. But the opportunity extends beyond starting a business. It also includes career advancement. The last crisis saw numerous junior managers ascend the ranks as they stepped up during tough times. Number 4, hold on to your investments. Staying calm is easier when your investments are on the rise. Imagine buying Bitcoin at $1,000 than watching its value soar. In contrast, bear markets often trigger impatience and rash selling due to fear. But the stock market has withstood severe challenges like the Great Depression and major wars. The investors who triumphed either sold early, which is hard because predicting market crashes is tough, or held on through the crisis until the market bounced back. Number 5, embrace the gig economy. Job hunting can be tough in a recession. That's where the gig economy with its short-term jobs and freelance roles comes in. This sector usually thrives during downturns. Online platforms are teeming with opportunities, whether you're into writing, design, coding, or other skills. Starting with lower rates and working up as you gain experience can be a smart move. Your skills can be your economic lifeline, always in demand regardless of the market situation. Platforms like Fiverr and Upwork are great places to start. Number 6, avoid debt. Being unprepared for a recession can lead to struggles. Many fall into debt when they can't cover basic needs. Recessions, often sparked by financial bubbles or inflation, can lead to higher interest rates, making debts cost lighter. For example, in 2007, at the height of the housing bubble, the Fed raised rates to 5.25%. In 2000, during the dot-com bubble, rates hit 6.5%. Recessions often widen the wealth gap. Those with less may need to borrow for essentials, while the rich can capitalize on opportunities without going into debt. So avoid debts by all means. Number 7, look to precious metals. In times of economic uncertainty, precious metals like gold and silver are smart investments. They usually maintain their value better than other assets in tough times. Options for investing include physical purchases or ETFs and stocks in mining companies. Gold and silver's intrinsic value, scarcity, and the effort to mine them shields them from the usual economic ups and downs. These metals are seen as stable stores of value and aren't reliant on any single country's economic health, making them solid choices in global downturns. Hope these tips not only keep you afloat, but also help you come out of 2024 wealthier. Remember to subscribe for more insights on investing.